Hello traders, the title of this video is 6 facts one should know about the first Elliott wave. Alright, so we have been talking about the first Elliott wave, and we know that very often there is equality between the first wave and the fifth Elliott wave. But what I'm about to discuss today, I don't want to talk about things that traders already know that we have discussed before, but I want to talk about 6 essential facts one should know about the first Elliott wave. So we already know that the first Elliott wave is a multi-wave, can be subdivided into 5 minor waves like the third and the fifth Elliott wave. We all know this now, and we have talked about it before. Alright, we also know that there is equality in length and magnitude between the first and the fifth Elliott wave. So we can use the first wave, the magnitude, and the length of the first wave to forecast the fifth Elliott wave. Alright, so we also know that the first Elliott wave can also be extended like the third, and the fifth Elliott wave. But let's talk about the 6 facts one should know about the first Elliott wave, because a lot of traders are using the Elliott wave, and we want to understand the characteristic of each wave. This will help us to become a better Elliott wave traders. Let's get started. So first thing first that we must know about the first Elliott wave is that the first Elliott wave's internal waves helps to forecast the motive wave. Alright? So I will say it again. The first wave's internal waves help to forecast the motive wave. This is a very powerful fact about the first Elliott wave, and if you are using the Elliott wave theory, or you like to forecast the market, that's why I put it at the top so we can discuss it now. The structure, so the internal wave, can be subdivided into 5 minor waves, and with those internal waves of the first wave, we can forecast the whole trending phase of the Elliott wave cycle. So the trending phase of the Elliott wave cycle is that what we call the motive wave. So how far the second wave went down in relation to the first wave will help us to forecast how far the real second wave will go down in comparison to the real first wave. Okay? The extension of the third internal wave of the first wave, the structure of the third internal wave of the first wave, will help us to forecast the real third wave. And the structure of the fourth wave will help us, or the fourth internal wave of the first wave will help us to forecast the real fourth wave. And the structure of the fifth internal wave of the first wave will help us also to forecast the real fifth wave. But you have to understand that this is a guide. So I recorded a video last time, and we were talking about how to avoid using the Elliott wave theory like a science. So it's a guide. Though it looks like a science, it looks like exact. Alright. Sometimes you will forecast the market, and it will be exact, and you will feel like God, or you will feel like somebody powerful, you'll feel like mighty or something like that. But just remember that it's a guide, and sometimes you may not see it exactly as the structure is, but with that, that's why we say guide, we can work with it, we can have a bit of idea what is likely to take place. But the mistake that we don't want to do is to go ahead before the price thinking that yes, it will do this, but it will do something else. Alright, so remember that the price, we are following the price, but don't go before the price. So use the structure, the internal wave or the first wave, have your forecast, put it aside. Alright, this is your expectation. Alright, now keep your eyes wide open and use the basic technical analysis. Break the ball, retest it around, break below, retest it around, and do not violate the market pattern, one step at a time. But sometimes you will see that it will follow the structure, the internal waves of the first wave, and you will be so excited. All right, but it does not happen all the time. So if something can work, remember this, We are talking about probability. If something can work, okay, 60% of the time, that's very, very good. We can work with that tool, all right? It's good, isn't it? Yeah. 60% is great, all right? Above average, normal average, so it's good. So we can work with that. So this is about, okay, the first wave, internal waves, help to forecast the whole multi-wave, the trending phase of the Elliott wave cycle. That's the first fact that you will do everything to master. Otherwise, I mean, you cannot use the Elliott wave to forecast the market. So if you are trading, for instance, the blue chips stocks, you will know that expert Elliott wave practitioners are busy forecasting the market to their client, and they will be using, okay, what I'm talking about today. So you are likely to see that they are playing with this, facts in the financial market, but it's not an exact science. It's a guide that can help us to forecast the financial market. That's the first fact, okay? Second fact about the first Elliott wave is this. The first wave structure is often a predictive fractal pattern of the multi-wave. So this is another way to explain to you what I've already said to you in the first fact. But that is a little bit different because I use another keyword, is predictive fractal pattern. I will not dwell on this, or I will not dwell on it, but there are videos about the predictive fractal pattern at Day Pro Traders YouTube channel. There is a playlist about predictive fractal pattern, okay, at dayprotraders.com, and I will only refer you to those, okay, playlists at Day Pro Traders YouTube channel. So in fact, the first fact, there is a bit of link between the first fact and the second fact, but with a little bit of difference because we are mentioning, okay, the fractal pattern of, the first wave. So we are talking about the first wave structure is often a predictive fractal pattern of the multi-wave, all right? So how the first wave, not only about the ratio, how it falls, but the structure, all right? So let me show you one example of a fractal. Suppose I'm draw something like this, okay? All right? Suppose I draw something like this, all right? And I say to you, this is the first wave. I use the word suppose, all right? Very important, all right? Don't criticize me in the comments. Suppose we call this the first wave, okay? Now, you see the structure of this drawing, this supposed to be first wave. If we are talking about the first wave structure is often a predictive fractal pattern of the multi-wave, it's telling me that if the real multi-wave is underway, it will also have a shape like this, which will be a little bit bigger, but will be similar structure. Are you getting the message? That's why I'm saying to you there is a little bit difference between, the first fact and the second fact, you see? So this shape, so we are talking now about the shape, okay? So the first fact is more about the structure, all right? First, second wave, third wave, okay? First internal wave for the first wave, second internal wave, third, fourth, fifth internal wave of the first wave to forecast the multi-wave. Now, in the second phase, we are talking about the fractal pattern of the first wave. So it's something like this. The shape, we are more about the shape. All right. So you see now. So this is about the second fact about the first wave. So let me say it again. The second fact one should know about the first wave is that the first Elliott wave structure is often a predictive fractal pattern of the multi-wave. All right, if it's not clear, all right, put your question in the comment section. The third fact about the first wave is this. The first wave rarely extend because the first buyers or smart money do not want to reveal their footprints. Did you get that? All right. So we know that the first wave, the third Elliott wave, and the fifth wave are all multi-wave, and they can be extended. All right, beautifully extended. But the first Elliott wave rarely extend. Why? Because the first buyers, who are the smart money, do not want to reveal their footprint. So they will do everything to hide their trading activity. So can you imagine Goldman Sachs or any other investment bank or any hedge fund will go and say, oh, what we are doing now, we're going, but sometimes they do say it on, come on television and say, okay, we are bullish on gold, we are bearish on this, all right? So they say that. But at the time when they start accumulating the financial instrument, they don't go around and say, guys, we just start buying gently this stock. They don't do that, all right? But when they go on television saying that we are bullish on gold, it means that the whole position for some time now, they bought it already. Nothing is, maybe they're already in profit. So they will say it now. It's too late. But at the time when they are accumulating the financial instrument or they are distributing, because both ways, they sell and they buy. So when they are selling gently, all right, they are distributing the financial instrument to other investors that do not know that they shouldn't be buying that financial instrument because it's overbought. So that's what we call distribution. But at the time when they are buying, they buy gently over a period of time, okay? That's what we call accumulation. So the reason why the first wave rarely extend is because the first buyers or smart money do not want to reveal their footprint. There are more to this. Sometimes when you see that the first wave is extended, sometimes some stock, you see a stock will belong to a sector, all right? And that sector may be bullish. All right, let's call healthcare sector, okay? Suppose the healthcare sector when it was bullish, and a stock may belong to that sector, okay? So for one reason or another, every stock is going up, very bullish, but that stock is just hanging there. It's not going anywhere, all right? But it's just late. Fundamentals are still good. It belongs to a bullish sector, but it's still in one place. Suddenly, I'll tell you more about this. Everybody say, what's going on with this stock? Why this one is not going up? Now, people want to buy more because they want the bullish momentum to continue. They know that that sector is bullish. They will come back and everybody start buying that stock. When you see that, the first wave it will be extended. So if they don't want to hide their food, everybody will just keep buying, and the first wave will be extended. So feel free to disagree with my explanation here, or if you have any comment, or I put it in the comment section. For traders that are trading forex, okay, as we are dwelling on this subject of the first wave rarely extended because the first buyers of smart money do not want to reveal their footprints. You also notice this when you are trading forex, that sometimes economy news may come out and the British pound, US dollar currency pair, which is positively correlated to the euro dollar, may start going up first. So it may go up, and the euro may be just going down or doing something else. And then later on, currency pair that are positively correlated to the British pound, US dollar, will start going up. The euro dollar start going up first. We start following the British pound, or the inverse may happen, or the euro may go first, going boom up when the British pound may be lagging, and then later on you see that everybody come and buy. Those can happen during a bullish day, so very bullish day, but some financial instrument may be lagging. And you will notice that the first wave very often will be extended in those scenario. All right. So this is about the third fact one should know about the first wave, which is the first wave rarely extend because the first buyers or smart money do not want to reveal their footprints. All right. The fourth fact that one should know about the first Elliott wave is that technical traders use the length and the magnitude of the first Elliott wave to set a profit target. Now, you need to, some trader may say, George, I already know this, but it's so important because you have to understand where people are taking profit is very important. So if you can know where people are entering their trade, you have an edge. Suppose you know everybody in the market, you know when they enter their trade. That's a powerful information. And also, if you know where people are likely to take profit, that's a very powerful information. So by telling you today that the technical traders use the length and the magnitude of the first wave to set a profit target is powerful information. What do I mean by length? Length, so like this, from the starting point So the orange line on this chart, that's the length of the first wave. Now, if you are talking about the magnitude, it's from the high to the low, the vertical line. That's the magnitude of the first wave, and this is the length of the first wave. So as this talk, you see the first wave and the second wave is completed. Trader will do like this. They will use the length to project it up to set a profit target. Some trader will do that. Some trader will use the magnitude of the first wave to set a target. And at every resistance, as the price breaks above that target level, right? I talk about 150 Fibonacci extension level at Day Pro Trader YouTube channel. You need to watch that video. All right, let me tell you, the title of the video is something to do with what I'm talking about now. Looking in my book here, Fibonacci Trader explain the 150% Fibonacci extension. So check it out. So as the price goes above, okay, each target. Okay, so if it goes above the target, the length, they will project it again above that. It goes above it, they move it, and they just use it to set profit target. And they will also pay attention to the median line of the length of the first wave. And those who are using the magnitude of the first wave will do like this. They project it, price hit the target, it breaks above, retest, they project it again, it goes above, retest, then around, and they use it as a measuring stick to set profit target in the financial market. So this is about, okay, the fourth is facts, okay, one should know about the first Elliott wave, which is that technical traders use the length or the magnitude of the first wave to set profit target in the financial market. All right. The fifth fact one should know about the first Elliott wave is that the first wave often is a breakout wave. This is very, very, okay, important, all right? The first wave is a breakout wave. Now, if I can brainwash any Elliott wave trader, this is the first thing I would do, okay? Stick in your brain, push it there, all right? First wave is breakout wave. First wave is breakout wave until you get it, all right? You see now? So it's so important. So why it's so important? Right? That's the question. It's so important because if you get it wrong, suppose you start counting wave, okay? You are Elliott wave trader, you are counting wave, okay? If your first wave is wrong, your whole wave count is wrong. That's it. So you get the first wave wrong, you are likely to get the second wave wrong straight away. And you are likely to get maybe the third wave wrong, and the fourth wave wrong, and the fifth wave wrong, because your first wave, your first wave is wrong. So by knowing that, okay, the first wave is a breakout wave, it's a powerful information. All right. So on this chart, as I'm looking here, I don't want to go into wave count mode. All right. Now looking at this chart here with the information that I have here, I will call this one, okay, the first wave. I will call this one the first wave because first wave is a breakout wave. You see here, there are resistance here, and it breaks above it nicely. There's a consolidation, it breaks above it nicely. There was a trend before, probably come back all the way to the starting point. Now consolidation, here it is. And also you see, I will talk about the last part, which is what I'm about to talk about now. I'll leave it and I'll talk about it soon. You see the year 2003, what is happening there in 2003. We have the commodity boom. All right, you see now? So here it is, breakout wave. It's a breakout wave. With that information, you are ready to detect correctly the first Elliott wave and start your wave count, okay, on the right foot. Because if you get the first wave right, even though you may call something else, okay, second wave and so on, you are likely to make better trading decisions than somebody who gets it completely wrong, okay? So I would like to recommend to traders, as I'm talking about, the first wave is often a breakout wave, which is the fifth fact one should know about the first wave. I would like to refer traders to the playlist that we call Wave Count Guidelines. So you go to www.traderyoutube.com /24elliottwave.com. So digit 2, digit 4, Elliott Waves in plural.com, and you click on wave count guidelines. I talk about how to count wave, and you will understand more. Okay, so how you detect the first wave? You may see an inverted head and shoulder. So there was a trend before, and then a correction has begun, and at the end of that correction, you may see an inverted head and shoulder chart pattern. Okay, something like this here, and then a breakout, or you may see correction and then a consolidation and then a breakout. All right, very good. And then this is what we are talking about. So the first wave is a breakout wave. Very important information, so you may get the first wave correctly. Okay, the last point, which is the sixth fact one should know about the first Elliott wave. Here it is, my friend. Are you ready? Valid first wave reflects the current market sentiment. So the reason why I put those last 2 points below is because they are so important. All right, valid first waves reflect the current market sentiment. So you may say, George, what's that? What's that blah 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 from you, George? Okay. All right. Now the point I'm making here is that you can see 2003 we have a bullish, okay, commodity market. Market was bullish, all right? So you see this first wave is reflecting the current market sentiment. So sometimes trading accounting wave, they say first bullish wave should appear during a bullish market. So that's the point I'm saying here. First bearish wave should reflect the current market sentiment that is bearish. Don't call, I mean, I need to be a little bit careful here, all right? I'm not saying that, okay, bullish first wave is always happening, all right, during a bullish market time. I'm not saying that bearish first wave always, okay? So if we are talking about a proper trend, we are not talking about on the hourly time frame, on the 50-minute time frame. We are talking about, for instance, on the monthly chart, all right, a proper trend that is starting, okay, that first wave will reflect the current market sentiment. All right, so just remember that. All right, so if, for instance, you are counting wave on a monthly chart, make sure it's reflecting the current market sentiment. All right, now there are times when they call some financial instrument defensive financial instrument that will trend against the current market sentiment. For instance, during the bearish season, people will buy the pharmaceutical. During the bearish season, yes, people will buy the pharmaceutical. They call it defensive stock that can go up when the market itself is going down. But it's quite risky all the time when you are playing against the market itself. But generally speaking, a valid first wave will reflect, okay, the current market, which means you will see bullish first wave at the beginning of a bullish cycle, a bullish trend. All right. So you see in 2009 when the S&P 500 was turning, that's the time to buy and hold, was turning from bearish to bullish. You will see that a lot of other financial instruments, stock, will also start exhibiting as the market itself, which we call the S&P 500, exhibit the first wave. All right, you will see that stocks that belong to the same group will also exhibit, okay, the first wave. That's what I meant by the first valid first wave reflect the current market sentiment. On the other hand, if the market is turning from bearish to bullish, okay, it's turning from bullish to bearish. All right, or we need to. Okay, you are likely to see bearish first wave, but you have to make a difference between corrective first and trending first. So the market is about to start a bearish trend by turning from bullish to bearish. If the market exhibits the first bearish wave, other stock will follow suit and exhibit the first bearish wave. This is what I meant by valid first wave reflect the current market sentiment. So when you see your first wave, especially on a monthly chart, try to see whether it's aligning with, okay, the current market sentiment, because you want to catch the third Elliott wave, which is a very bullish or very bearish, okay, wave. Should be dynamic. You want it to align with, okay, the market itself. So if you are position trader, swing trader, and investor, this is very, very important for you to understand, because market participants that are so obsessed with the wave forecast, those are people who are investing a huge amount of money in the financial market, and they want to have a bit of idea, okay, is it worthy in putting millions into this or not? So this is about very, very important for you to know what you are doing. Somebody may present you with an Elliott wave forecast, verify whether the first wave is reflecting the current market sentiment, and then if you have a second Elliott wave, you have a good chance to catch the best portion of the trending phase, which is the third Elliott wave. All right. So this is the end of this tutorial about the 6 facts one should know about the first Elliott wave. The first fact, quickly, the first is that the first wave internal wave help to forecast the multi-wave. The second fact is that the first wave structure is often a predictive fractal pattern of the multi-wave. The third fact about the first wave is that the first wave rarely extends because the first buyers or smart money do not want to reveal their footprint. All right. The fourth fact about the first Elliott wave is that technical traders use the length and the magnitude of the first wave to set a profit target. And the fifth fact of the first wave is that the first wave is often a breakout wave. The last point that we have discussed about the first wave is that valid first waves reflect the current market sentiment. Now, if you think that this is another blah 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 from my side, I want to know, please give me the thumbs down so I know that, okay, I need to improve. All right. And if you think this is a great video, well, give us the thumbs up. All right. If you do not log in, you can read this video, so you need to log into your YouTube account, okay, or use Android, so you stay logged in, so you can give the thumbs up, a thumbs down. Okay. Now, if you have any question or suggestion, all right, put it below, and into course I will be recording another video to address your question. Okay, we wish you the very best in your trading, and until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about the 6 facts one should know about the first Elliott wave. Happy trading to you all, and speak to you soon.